Imagine if the force moving crypto had nothing to do with the blockchain, nothing to do with Bitcoin's tech. It's this: a group of economists in a closed room deciding whether to rise or cut interest rates. And that decision could ignite a crypto bull run or sends it crashing. Let me show you how it works. Interest rates are simply the cost of borrowing money. Currently, the US effective federal funds rate is 4.33% at the time of this recording, the highest level since 2001. High rate. Borrowing is expensive. Less spending. Economy cools. Low rates. Borrowing is cheap. More spending. Economy heats up. The Federal Reserve sets this rate by controlling short-term liquidity at regular meetings, usually 8 per year. The Fed's decisions are data-driven. They watch inflation. Is general price growth too fast? Employment. Are people working or not? Economic activity. Is the economy weak or strong? Consumer and business borrowing trend. If inflation is high, economy is strong, raise rates. If economy is slowing or inflation stabilize, cut or pause. As of now, inflation remains above the 2% target and the Fed is holding steady. Analysts expect rates will stay around 4.25 to 4.50% through at least September 2025. But here's what they don't say. The Fed helped cause this inflation in the first place. They printed trillions of dollars in stimulus during the pandemic, pumped liquidity into the system, and kept rates near zero for too long. Now, that inflation is too high. They're slamming the brake and you, the taxpayer, are paying for it. They raise rates, slow the economy, and then sell US debts to finance the system. But here's the problem. That strategy isn't working anymore. Investors are demanding higher yield. The debt is ballooning, and trust in the system, it's breaking. Since early 2022, the Fed has been in a tightening cycle, starting from near zero rates in 2021, multiple 75 basis point hikes through 2022, cliffed around 4.25 to 4.50% through 2023 to 2025. That wave of rate hikes sapped liquidity from financial markets, including crypto, which is why we saw a prolonged crypto winter in 2022 and 2023. The Fed will start to cut rates when inflation returns close to 2%, growth slows significantly, or if a recession emerges. Historical data shows rate cuts have often followed economic downturn, and that 86% of the time, stocks saw gain 12 months after the first cut. Crypto usually follows the same macro signal. It's driven by liquidity first. Here's how to think about it. High rates equal caution mode. Crypto dries up, risk asset money pulls back. Cuts or pauses. Fertile ground. Liquidity starts returning, risk assets come alive. Stay informed. It's not just about charts, it's the macro setup. Track inflation reports, Fed commentary, Fed fund futures. Crypto doesn't move on blockchain alone. It's deeply tied to global monetary policy. Right now, we are at the highest interest rates in 2 decades, held steadily to fight inflation. Liquidity is tight. But when the Feds finally pivot, everything changes. So don't just trade the breakout, trade the macro behind it. If this clarified how crypto and macro interact, hit that like, share it with someone who still think macro doesn't matter. Comment below, do you think the Fed will pivot soon or hold longer? I read every comment. Subscribe for more breakdowns. My name is Lamia. Thanks for watching and I'll see you in the next one.